want to keep going right ahead, and delighted to have Undersecretary for Domestic Finance of U.S. Treasury, Nellie Liang. Nellie has served a really tremendous career in public service, from Treasury now, but she was at the Federal Reserve Board for many years, and in between at many different government agencies. We are absolutely delighted to have Nellie Liang here to speak with us, and she's going to talk a little bit especially about the Treasury markets, a very important market for our financial markets. And Nellie's conversation is going to be moderated by Michael McKee of Bloomberg, and she's going to start off with some prepared remarks, and then we'll have a little conversation with Nellie Liang.
Thank you for the invitation to be here, be part of this conference on financial market quality and the opportunity to speak. I want to thank especially Rena for the privilege to speak here on Treasury markets and how we try to ensure the quality of Treasury markets. So in my remarks today, I will focus on what the work and reforms we have been implementing to ensure the resilience of Treasury markets. And this market serves the role of financing our government at the lowest cost to the taxpayer over time, and is at the core of global financial markets. It provides the benchmark risk-free yield curve, and it helps underpin the role of the dollar in global transactions. And being the deepest and most liquid market in the world, it serves as a key source of safe and liquid assets for investors, and is used for liquidity risk management by many financial firms, both banks and non-banks. And the Treasury market has evolved significantly over the last couple of decades, driven in part by regulatory and technological changes, themes that connect naturally with this conference focus on innovation and uncertainty. For example, electronic trading and shifting types of market intermediaries have changed how market liquidity is provided. While traditional dealers have been the main participants in the interdealer market, principal trading firms, PTFs, now represent the majority of trading activities in the futures and electronically brokered interdealer cash markets. And we saw an implication of these changes in the Treasury market flash rally in October 15th, 2014. And it was that event 10 years ago that led to the expansion of the work of the Interagency Working Group on Treasury Market Surveillance, which we call the IAWG. And at the same time, we've seen an increase in the amount of Treasury securities outstanding and relative to the capacity of dealers to provide liquidity to these markets, partly reflecting the effects of regulations that were adopted in response to the global financial crisis in 2007 to 2009. And moreover, in recent years, demand for US Treasuries have become more broad-based and shifted towards more price-sensitive investors, such as pension funds, money market funds, mutual funds, and hedge funds. And some of these funds are reliant on the ability to quickly sell Treasuries to meet their liquidity needs, which increases the potential for surges in Treasury sales. So I'm going to turn now to an overview of current Treasury market conditions. And next, I will review our most significant efforts in recent years to strengthen the resilience of the Treasury market. And finally, I will conclude with a few thoughts on some unfinished business. So to assess Treasury market functioning, we monitor a variety of metrics for both the secondary and primary markets. And these are metrics that are similar to ones followed broadly by market participants. So just looking at this first slide, the figure on the left shows our composite index of trading conditions. And we're showing them for the 2-year and the 10-year Treasury notes from 2019 to present. And its inputs in this index are for bid-ask spreads, market depth, and price impact measures, where higher values indicate higher costs of transacting, meaning less liquid market conditions. There are two things to take away. First, costs can rise very sharply and quickly, as you can see in March 2020 at the onset of the pandemic, and again in March 2023, when several banks faced depositor runs and failed. A second takeaway is that costs generally do not vary significantly day to day, but have been slightly higher since mid-2022s than the period before. And this pattern reflects that transaction costs are generally higher, correlated with interest rate volatility. And you can see this relationship in the right side panel. There's an upward slope between rate volatility, which is on the horizontal axis, and this index for the 10-year Treasury note, where volatility and costs are lowest in 2019, which are the dark blue dots, and both are also higher in 2022 and 2023. What you can also see is the red dots that sit way above the cloud, which illustrates that in March 2020, transaction costs were much higher than might be expected given the higher even for the higher volatility. And this outsized reaction illustrates what has been called the dash for cash episode, when Treasury prices fell sharply in contrast to a typical pattern for Treasury prices to rise in periods of high uncertainty when investors run to safety. And it reflects that some investors, including some open-end mutual fund funds and hedge funds, rapidly sold Treasury securities to meet redemptions or margin calls, and in amounts that exceeded the ability or willingness of dealers to supply liquidity. So in this episode, the Federal Reserve had to step in, and they purchased Treasury securities in significant amounts to support smooth market functioning. Since then, market liquidity conditions have been more stable. When volatility rose sharply again in 2023 after the bank deposit runs, the higher transaction costs, which are shown by the purple dots, were relatively in line with the higher volatility. Importantly, market conditions remained orderly, and moderately reduced liquidity did not amplify volatility during this period. I would note that the event in early August of this year, which is captured within the green dot cloud, suggests the steep drop in global stock prices with some unwinding of carry trades did not cause a deterioration in Treasury market liquidity. So turning to primary markets, they also are functioning well. Treasury's long-standing regular and predictable issuance strategy, described recently by Assistant Secretary Josh Frost, helps to support smooth market functioning. And on this slide, you can see two commonly used metrics to assess primary market functioning, and showing here for the 2-year and the 10-year notes again. One indicator on the left is the bid to cover ratio. And this is the total amount of bids received at the auction divided by the total amount of Treasury debt that is being offered for sale. This measure has been pretty stable and has been well above 1, which would be exactly covered over the past several years. And I would note, even when there were sharp increases in the secondary market costs in March 2020. And bid to cover also has not changed as issuance has been increasing, which suggests continued strong demand for Treasury securities. And similarly, as shown on the right, these are data on auction tails, which compares the yield set at the auction price, to the yield when issued trading. And this shows that auction results have fluctuated both above and below market expectations, and within a pretty tight range. This range is really, the wide range is plus or minus 3 basis points, even as variability increased when interest rate volatility moved up starting in 2022. So at the start of this administration and following the Dash for Cash in March 2020, we embarked on a comprehensive effort to improve the infrastructure of the Treasury market to ensure that the Treasury market remains the deepest and most liquid market in the world. Through IAWG, we set out guiding principles, which includes transparency to foster public confidence, fair trading, and a liquid market, and prices that appropriately reflect economic and financial conditions. And we also put a strong emphasis on ensuring its resilience in periods of stress. So the 5 work streams that are at the heart of our efforts are outlined on this slide. And we've documented our progress each year, and we'll publish an annual new update next week ahead of the 10th Treasury Market Conference in New York. Overall, I would say we have made significant progress, even as some work remains. So let me start with the first one, improving data quality and disclosures. Here we've made great strides. Working with FINRA and starting in February 2023, we began publishing aggregate transaction volume data on a daily basis. Before that, only weekly data on transaction volumes were available. And furthermore, earlier this year, we began to disclose data on price and quantity with caps for the on-the-run securities at the transaction level at the end of each day. While we've greatly expanded data availability for market participants and for researchers, for those of you in the audience, we've also been very deliberate to avoid potential harms, such as disclosing data that could reveal confidential trading positions. In addition, we've taken steps to close a large data gap in a critically important repo market, and that is for the non-centrally cleared bilateral repo. And data collection at the transaction level will start this December, based on a rule that was finalized by the Office of Financial Research earlier this year. And these new data will allow the official sector to better assess vulnerabilities in the repo markets. Second, to strengthen the resilience of market intermediation, Treasury started a Treasury buyback program this year. This program offers to purchase off-the-run securities. It creates predictable opportunities for dealers to sell off-the-run securities to Treasury. We think this should encourage market making and free up balance sheet allocated to less liquid positions. And we will be monitoring closely how this new market will affect trading activity and liquidity. And in addition, relative to March 2020, there now are 2 Federal Reserve facilities that should support liquidity in periods of high stress. First is the standing repo facility to finance Treasury repo, set up with pre-authorized banks and primary dealers. And then there is the Foreign and International Monetary Authorities facility, FEMA, for certain foreign central banks. Turning to the third work stream on trading venues and oversight, the SEC adopted new rules this year that requires firms that have significant liquidity provision roles, such as principal trading firms, PTFs, to register with the SEC as a dealer, and is working to finalize its proposed regulation ATS to enhance the resilience of electronic trading venues. And these new rules recognize the emergence of new types of firms and practices based on advances in data and computing, and will provide better protections to investors and promote market stability. Fourth, a key IAWG initiative was to evaluate central clearing for Treasury securities. After substantive engagement with market participants and other regulators, the SEC adopted final rules to require the central clearing of Treasury securities transactions. Expanded central clearing should increase the intermediation capacity of dealers through netting, It also could reduce counterparty risk and increase transparency in these markets, and could incentivize some all-to-all trading. And market participants are working towards deadlines for cash securities by year-end 2025 and for repo by the end of June 2026. All of these efforts help to ensure the Treasury market remains liquid and resilient. However, there's also some unfinished business, and I'll touch on these next. So, continuing with central clearing, there is very important implementation work ahead. The new mandate will lead to a significant increase in the volume of transactions to be centrally cleared, and currently there's only one firm that clears U.S. Treasuries. Other firms have expressed an interest in entering this market, which raises interesting questions around the costs and benefits of having multiple clearinghouses for Treasuries. Would participants benefit from greater competition, or would they lose netting benefits? From a macro perspective, are there gains to operational resilience from multiple clearinghouses, or higher risks from greater complexity? Regulators will need to be monitoring progress and address these types of questions. While central clearing should help ease dealer balance sheet constraints, as I mentioned, the banking regulators also should consider changes to the supplementary leverage ratio to help improve the elasticity of the supply of market liquidity. And proposed options would include excluding reserves held at the central bank and making the enhanced SLR buffer countercyclical to be released in periods of market-wide stress. These types of changes could be accomplished without reducing the overall amount of capital in the system and would allow bank dealers to better able to make markets in periods of high stress. And finally, as I noted earlier, and going back to this fifth work stream, Treasury securities are used for liquidity risk management by some types of investment funds, such as open-end bond and loan mutual funds, which have grown to hold a significant share of corporate credit. These funds have a liquidity mismatch between the daily redemptions that are offered to shareholders and the longer time it takes to sell what are the underlying assets, the bonds and the loans. To address this, what we call sometimes phantom liquidity, and the need to rapidly sell large amounts of treasuries for liquidity to meet these redemptions, the IAWG advocated for, and the SEC proposed a rule with some options. However, there was substantial industry pushback because of operational impediments to proposals like swing pricing, and the recently issued final rule dropped this feature. And the SEC and industry should continue to explore other possible solutions. In addition, we also saw in March 2020 that leverage in the Treasury market could become excessive and destabilizing. Much attention has focused on the cash futures basis trade, in which hedge funds take short positions in Treasury futures, corresponding to long positions taken by asset managers, and finance their long treasuries with repo. This basis trade supports Treasury market functioning in normal times by tying together the cash and futures markets and serving as an important source of demand for Treasury securities. However, research has highlighted repo haircuts that have been reported at zero, and that deleveraging by hedge funds contributed to the dynamics in March 2020. While reported haircuts on repo may not fully reflect the leverage of the overall trade, several reforms that have been mentioned above will shed a brighter light on practices. And in the near term, the SEC now collects more data on hedge fund leverage and makes aggregated data available. And bank supervisors are enhancing their work on how banks manage their hedge fund exposures. Over time, the new data collection on bilateral repo transactions and the central clearing mandate for repo should improve transparency, and standardization, providing some market-based discipline to prevent excessive leverage from building. Since the basis trade remains sizable, it does remain important for regulators to continue to monitor leverage and to balance the benefits of leverage for repo versus resilience in periods of stress. So let me conclude. Our indicators suggest continued robust demand for Treasury securities, and the market remains the deepest and most liquid market in the world. The strength of the Treasury market is a privilege that allows the US government to finance itself at a lower cost than it would otherwise. But it also comes with the responsibility to continue to ensure its resilience. For the past few years, Treasury and the financial regulators, consulting with industry, have made important changes to the market infrastructure. I believe these changes have made the Treasury market more transparent and more resilient, even as some work remains. And of course, we should expect the market will continue to evolve with new technologies and innovations, and that regulators will need to continue to address new risks while allowing for the benefits of innovations as they arise. Okay. Thank you again, and I look forward to our conversation and your questions. Thank you.
We'd like to thank the Secretary for a very good outline of everything that has happened up to date in terms of the interagency working group and the market reforms package that is underway. But there are still some things that people want to know. Much of what you were talking about today deals with the secondary market. You can always tell that someone's view about something depends on where they sit.
Yeah.
So you can probably figure out, this first question came to me from somebody on a primary dealer's desk. How do regulators see primary dealers within the structure of Treasury market trading and liquidity, because their participation in auctions has steadily declined since Basel III came into being? And are you concerned about intermediation and liquidity in the primary market?
Okay. So the primary market, thanks for the question, and thanks for being here. Primary dealers are a critical part of the functioning of Treasury markets. They participate in every auction, or they certainly are required, if asked, to participate in every auction. And we consult with them regularly on what they view as investor demand and their demand. So to issue treasuries, and just to provide a little background, there's a regular process for how we issue treasuries, and primary dealers are a big part of that. As I mentioned, we have strong demand at auction. Bid to covers are very high, so dealers have not been required to bid, but we have a very robust and diverse investor base. We work hard at it. So there's a regular quarterly process. Every quarter is called the quarterly refunding process. And we go out beforehand and talk to market participants, including dealers. And there's a Treasury Borrowing Advisory Committee, a formal group that meets with us every quarter before the auction and advises us on market conditions and what coupon sizes or bill issuance. We follow what is called a regular and predictable strategy, and the goal is to keep costs as low as possible and to support market liquidity. Regular and predictable allows dealers to better plan. We view them as a critical part of the process. The fact that they don't have to take a large part of every auction is a good sign. That means we have a very large and diverse investor base. So I think we stick to regular and predictable. Doesn't mean we can't change our sizes, but we do them gradually. So that allows dealers to plan better, it allows investors to plan better, keeps our costs as low as possible, and makes the market liquid.
Well, a follow-up to that, and it also ties into what you were saying about the supplementary leverage ratio. Yeah. A lot of banks aren't warehousing what they used to anymore. Yeah. And I think the question that a lot of people have is, why has it taken so long to get a decision on SLR, since most of the world seems to want something to happen fairly quickly? And I'm sure that our next speaker is listening carefully to this answer.
So SLR is, one, just to be clear, is not part of the Basel III proposal. So as everyone who's involved with banking knows, Basel III has been a big part of the discussions for the last year. So SLR is not part of that. So there would be, it would not get addressed until after Basel III was discussed. But it is something we raised. It has been in the background, something that we raised early on, and IAWG did it. I did it before I started in this administration. And during the March 2020 event, the Fed did relax the whole supplementary leverage ratio for 1 year to allow the markets to resume smooth functioning. I think if it were on a pre-planned, expected basis, it could even be more, more useful and have a broader impact. So,
we have only a few minutes left, but let's ask any of the students, especially anybody have any questions for the secretary? I'm looking at everybody's looking at me.
There's right here. Right here.
Oh,
Hi,
okay.
Undersecretary.
There we
Thank
go.
you so much for being here. My name's Siona. I'm a sophomore in the college. And my question is, in light of the volatility in U.S. capital markets throughout 2024, particularly due to the current state of interest rates and global economic uncertainty, how is the Treasury working to ensure stability in the capital markets? Are there specific policies or reforms being considered to support market liquidity while managing the risk of a downturn? Thank you.
Well, thank you for that question. So there has been a lot of interest rate uncertainty since around 2022, mid-2022, as the economy has been recovering from the pandemic, recovering very quickly, and we have a strong economy. But the uncertainty about when the Federal Reserve will change interest rates, and also when other countries globally will change interest rates. I think our goals as regulators or at Treasury is not to reduce volatility, but to just ensure that the market infrastructure can absorb volatility, and not where the markets themselves create, because they're not allowing trading to happen quickly and efficiently, or you want to not allow too much leverage to create additional volatility. So I think regulators try to make the markets work, put the structure in place, but participants determine the prices and the quantities. And so I think regulators have focused quite a bit on trying to ensure what we call resilience and the infrastructure, the quality of the infrastructure. So I started with the Treasury market, the principles of providing markets that are fair, liquid, transparent, where prices reflect economic and financial conditions, is like the core of how we would approach different economic and financial conditions.
You mentioned central banks. We have 3 of them this week, and unfortunately, I can't ask you about that because we're out of time. We have one last question, and you'll get to dodge my question on monetary policy.
Some countries, such as Brazil, have issued inflation-adjusted bonds that are designed for retirement. That is, they would start paying many years down the road, and this would be a great product for the U.S. Translation, I would like to buy some here. Will the Treasury look at these for the U.S.?
So I mentioned something we call the TBAC, the Treasury Borrowing Advisory Committee, which meets with us 4 times a year. As part of the responsibility of being on the TBAC, they get questions from us. We call them charges. And every few years, we ask them, what are the new products that you think would be useful for Treasury to consider to issue? And we did one just recently. And these are ways for the US government to finance its borrowing needs and maybe expand the range of products. So sometimes, like, I think TIPS started there, right? And maybe floating rate notes. And so we do this periodically, and that's how we start our process. But we do, as I mentioned, we do go out and meet with market participants to discuss demand conditions, demand interest for various products.
So how can I get this idea into the ears of TBAC?
I would talk to TBAC. There's a list of the participants. You can also send our debt management office a letter. Primary dealers, if they're, you could talk to them about, because they're the ones who would have to keep some inventory of these products as well, so they could trade. We think we want products that can trade. That makes them more liquid products. Will keep our borrowing costs lower.
Thank you.
Sure.
Well, I mean, the dealers are only going to support a product where there's demand, and clearly
Yes.
there's demand.
There's clearly demand here.
We'd like to thank Undersecretary Liang for joining us today. Thank you very much,
Thank you, Michael.
and for a very illuminating presentation.